Hello everyone. In this week we will study lecture 5 in Managerial Finance. So we will study several basic concepts about return and risk. And second, we will introduce capital asset pricing model, which is CAPM. And we talk a little bit about market efficiency and market equilibrium. And finally, we'll do valuation of a common stock and valuation of a preferred stock. To understand what is expected return and risk, first we're looking at an example. Let's say we have a bond has the following probability of outcomes. When the economy is good next year, the return is 26% and the possibility is 0.1, about 10%. And the economy is good, the return will be 16%. The possibility is 20%. The economy is normal, the return will be 6% and the probability is 40%. The economy could be bad and the return will be negative 4% and the possibility is 20%. The economy could be very bad and the return will be 14% and the probability is 10%. Okay, given the data we have here, the return. So the return is expected rate of return of the bond during the next year. So it's going to be a sum up of the outcome under each condition with the corresponding probability. In this case, the expected rate of return is 6%. To measure the risk associated with the stock, with this bond, and we calculate the variance or the standard deviation for discrete probabilities. This is going to be the formula we're going to use to calculate standard deviation. Based on the data, we calculate that delta is 10.95%. That's for the risk of a individual stock. Now we're considering a portfolio return. If we have several stocks in the portfolio, so what is that return going to be? So basically the return is going to be a weighted average of the return of each stock in the portfolio. Why we do portfolio stock return is that we could diversify and minimize the risk. So as we include more and more stock in the portfolio, so we can minimize the diversifiable risk, which is unsystematic risk. And however, we couldn't eliminate the market risk. So we can see that a good portfolio, when we include around 10 to 20 stocks in a portfolio, we can efficiently and to eliminate diversifiable and risk. Okay, a standard long risk is going to be the market risk and diversifiable and risk. To measure the market risk, we can use a model is called a capital asset pricing model, which is CAPM. So CAPM is using that the contribution of a stock I to the standard deviation of a well diversified portfolio. So which is also we call the beta. So the beta of a stock is measure the relative risk to the market. Okay, so measure the impact of the stock on the market risk. Now we talk about the valuation of a stock, a common stock. So the common stock has value because the future cash flow is going to receive. So we can say that the future dividend at each time period. So the stock value is actually is the present value of dividends discounted at the required rate of return. To simplify our calculation, so we can assume that the dividend will grow consistently, and the growth rate is G. So the price of that stock is going to be dividend paid at the end of the first year divided by the required rate of return minus the growth rate of dividend. For example, we say the dividend paid at the end of the at the beginning of the first year is $2, and the required rate of return is 13%, and the dividend growth rate is 6%. So the price of the stock is $30. Another measure of the intrinsic value of the stock is going to use free cash flow, and we discount it by the weighted average cost of capital, and sum them up is going to be the company's operations value. And finally, we can consider the preferred stock as a perpetuity. The meaning is that the dividend will pay infinitely, so the holder of a preferred stock will receive dividend forever. So the value of a preferred stock equivalent to the dividend divided by the required rate of return of that preferred stock. Thanks for listening.